This is Matthew Kratters, Bitcoin University. Today I want to talk about the canary in the coal mine, which is Bitcoin. There's this question that's been haunting a lot of us. Why has Bitcoin's price performance been so poor over the past few months in spite of all the positive news surrounding the Bitcoin spot ETFs, surrounding Trump getting on the Bitcoin train and RFK Jr. being on the Bitcoin train, and the setting up of a possible strategic Bitcoin reserve? I think we now have our answer why Bitcoin has been performing quite poorly. It's because as an advanced liquidity indicator, Bitcoin has been telling us that the Fed has been too tight for too long, suffocating the economy. This is now showing up in official economic numbers. We see manufacturing activity in the US continuing to contract. We see the job numbers being much worse than expected, and we see the stock market now selling off quite sharply as a result of these numbers, not just in the US, but also in places like Japan, where the Nikkei has been getting absolutely smoked. Now, one sign that we're still so early is that Bitcoin continues to behave like a risk-on asset, like stocks. And so when people get scared, they dump stocks in Bitcoin and they rush into the quote-unquote safe haven of US Treasuries. We can see here the yield on the 10-year note in the US plummeting from above 4% now down to about 3.8%. As the price of the treasuries goes up, the yields move inversely and go down. So this is a sign of a large rally. We can even see it up and down the curve, especially at the front end of the curve, where the 1-year US Treasury is going off of a cliff. It was just above 5% a few days ago, and it's now in the mid fours. So why does the market flee into treasuries in a situation like this? Well, it's a bet that the economy is so bad that the Fed will be forced to cut interest rates and start buying treasuries again for its balance sheet. We can see the market is already pricing in some Fed funds, some interest rate cuts. For the September meeting, there's now a 31% chance that we get a 25 basis point cut or a quarter of a percentage point cut. There's a 69% chance that we get 50 basis point cut. And by the end of the year, we're seeing massive cuts across the board. The current target rate for Fed funds is 5.25 to 5.5%. And we can see here by the December meeting, there's a 44% chance it's going to be all the way down to 4 to 4.25%, or even as low as 3.75 to 4%. And this is part of the cycle that's unfolding globally as other central banks have already gotten ahead of the Fed and started cutting for their respective economies. The Bank of England cutting interest rates for the first time in over 4 years on August 1st, and the Bank of Canada cutting rates just a few days before that. This is probably going to be a really good thing for Bitcoin if we model it based on what happened the last time the Fed cut rates from about mid-2019 to early 2020 and the start of the pandemic. The Fed was cutting rates, and that's when Bitcoin went from, call it 10,000 to above 60,000 just a year or so later. So this is always quite bullish for Bitcoin, but there's more than that. There's the Fed's balance sheet. These are the assets that the Fed holds on its balance sheet. It's a mixture of treasuries and mortgage-backed securities, and they print up fresh money in order to buy these assets, manipulate interest rates, and put these assets on their balance sheet. And we can see that the Fed has been engaged in what's called quantitative tightening since 2022. They've been shrinking their balance sheet holdings by just letting these treasuries mature and not replacing them at maturity. So we could see this definitely take off in the other direction. From the beginning of the pandemic, the Fed's balance sheet went from about 4 trillion to almost 9 trillion. And so we can expect something even much bigger at this time because debt to GDP levels are much higher and the economy is much more fragile than it was even back then. So at one level, fleeing into treasuries makes sense as a short to medium term trade. It's not something you should really try to do, but it makes a certain amount of logical sense if you're expecting a recession and expecting the Fed to have to start growing its balance sheet again. But here's the bigger problem. The bigger problem is this overall debt load, with U.S. national debt being at 35 trillion and unfunded liabilities are at something like 217 trillion. This is all the future Social Security and Medicare and other unfunded liabilities, the entitlement programs that will need to be funded, that will be converted to debt on the balance sheet eventually. So you have something like $250 trillion worth of debt when you add it all up. And this is for an economy that has a GDP of only 28 trillion. So that's like someone who earns about $50,000 a year trying to service many tens of millions of dollars of debt. It's basically impossible unless, of course, that person has a money printer. And we do know that the Fed, as Bernanke said, has this technology called a money printer. Debt to GDP levels haven't been this high going into a possible recession in over 50 years. We can see where we are here. The levels have come off a bit from the peak of the pandemic, but we're still much, much higher than we've ever been since going off the gold standard in 1971. And we've never had these sort of debt to GDP levels going into a recession. So things could get quite nasty. It's pretty insane when you think about it, fleeing into U.S. government toxic sludge, these U.S. Treasuries, as a quote-unquote safe haven when the ship hits the fan, really doesn't make a whole lot of sense, especially now, as we've said, with debt levels so high. A U.S. recession and a stock market sell-off or even bear market will mean that the government will not be collecting as much money from capital gains or income taxes over the next coming months. Unemployed people don't pay income taxes, and investors losing money don't pay capital gains taxes, and it's especially those capital gains taxes on stocks and real estate that power much of the tax receipts of the U.S. And at the same time, the U.S. government, in a weak economy, will be forced to pay out more to the unemployed. We saw Intel lay off something like 15,000 people over the last couple of days. They announced they're going to do that. So U.S. budget deficits will continue to blow out as tax revenues fall and as spending increases. And the U.S. Treasury will need to issue even more debt, even more U.S. Treasuries to make up the difference. And then, of course, the Fed will need to print more money to soak up that excess debt. More printing means more inflation that destroys those who are trying to hide out in treasuries. And they think they found a safe haven, but they have not really found a safe haven. Now, fortunately, you and I know that Bitcoin is the real safe haven. So if you're hodling your Bitcoin in cold storage, you have nothing to fear from these drawdowns. You shouldn't even be watching your screen. You shouldn't even be watching the market. You don't have to worry about your bank blowing up because you're now your own bank. You don't have to worry about counterparty risks of any kind because you hold your own keys. You're not leaving your Bitcoin on an exchange like Coinbase where it can be hacked or lost or stolen. When you hold your own Bitcoin on a hardware wallet like the Cold Card, you eliminate all counterparty risks. And most importantly with Bitcoin, one of the most beautiful things about it is you also don't have to worry about monetary dilution. Satoshi is not going to increase the Bitcoin max supply just because the US might be entering into a recession. But you can be sure that Powell will be printing more dollars sooner rather than later. So stay tuned. August and September are traditionally the roughest months for the stock market, so things could get a lot worse before they get better. If you enjoyed this video, be sure to hit the subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.